Hello and welcome. So I just wanted to take a second to go back over this problem in a little bit more detail. Felt like I didn't explain it well enough, and so I wanted to explain it in a little bit more detail, okay? So again, we had this trial balance right over here, and then remember that $52,000, $7,000 of that was current. And what you needed to do was to create a classified balance sheet. And I asked you to use that format as we saw in a few pages earlier in your course notes as the template for developing your classified balance sheet, okay? I also told you that you're going to have to calculate the ending balance in equity by taking this capital right over here plus your net income, and your net income would be equal to your revenues minus all your expenses, and then minus your withdrawals. That would give you your ending balance in equity. And then the other thing that you had to do is to calculate your current ratio. So I wanted to talk about that. So again, this is what you should have gotten. This is what we went over towards the ending of the prior lecture video. You had your cash right over here, your accounts receivable, 15,000, prepaids, office supplies. That gives you your total current assets of 134,300. Then you have your office equipment less accumulated depreciation. This gives you the book value. That's the number that comes into calculating total assets. Then we have our building less accumulated depreciation gives us the book value. This is the number that comes into calculating total assets. Plus the land. Land is not depreciated. This plus this plus this gives us our total plan assets. There are no intangible assets. There's no long-term investments for this company. So you just don't include them. Okay? The 134,300 plus the 1,012,800 gives us our total assets of 1,147,100. Then we look at the liabilities and equity. We have our accounts payable as a current liability. Salary is payable is also a current liability. Interest payable is a current liability. And then remember we had that $7,000 of that $52,000. 52, $7,000 of that was coming due within a year, which means it's current. So we have our $7,000, which is our current portion of our long-term notes. We add up all these, we get total liabilities of $29,800. Then what we have is for our notes payable, $45,000. So then we have our total liabilities, adding those two together, of $74,800. And then we have our ending balance in capital, which is our equity. Okay, how do we figure that out? Remember, we took revenues minus our expenses gives us our net income. We start off with beginning capital plus our net income minus our withdrawals gives us our ending balance in equity of 1,072,300. We add that to our liabilities, gives us, and then we match up with our total assets and our balance sheet balances, and everything's right in the world, 1,147,100. Then what you needed to do was to calculate out the current ratio. So you take current assets divided by current liabilities, it gives you 4.5. Has a current ratio of 4.5, which means they should have no difficulty paying its short-term debt. And actually, this makes a good point. Cash alone, right here, is more than enough to pay your current liabilities. So they are in a very liquid situation, which means basically they have enough cash to meet their short-term obligations. They have more than enough cash. They're in a good spot. Okay? So again, if that current ratio falls below 1, that's a real problem because that means that current liabilities exceed current assets. And yikes. Okay? That's a problem. The other thing is that if it falls below 2 in general, it's probably not good. But below 1 is a real problem. This company, 4.5, good shape. Okay? In fact, that may sometimes your current ratio could be even too high because it means, see, your current assets don't really generate. Look at how much cash they have. Cash just doesn't generate much of a return. You're putting it in the savings account. That doesn't earn very much, or money markets. It's just not, it does not earn a high return. So what this company may want to think about doing is taking some of their excess cash, maybe expanding operations or doing something, excuse me, to earn a higher. Okay, as I was saying, they may want to take a little bit of this excess cash and use it to expand operations and basically earn a higher rate of return. Okay, because you don't earn a very big return on your cash just sitting in the bank account. Okay. All right. Well, that concludes chapter 4. Thank you so much.